Hi, everyone. Today is Thursday, August 6th, 2020. And for our free video conference this month, it's What's Safe. So I will be back momentarily to discuss what's safe, but I also want to invite you to check out the interview that I just did today with the Chief Fixed Income Strategist of Charles Schwab, Kathy A. Jones. We discussed a lot of very, very important things about what's safe. And she was very candid and transparent. So you'll get a lot of good insight from the top person who handles the strategy for fixed income for Charles Schwab. All right, and I will see you in a few minutes with some highlights from my discussion with Kathy, but also other tips that I think are very, very important for all families, all individuals, any adult in the US or the developed world, Canada, Europe, Russia, China, no matter where you are, the pandemic has affected the economy. Some worse than others, but it's affected all of us. So let's look at the data, let's look at the statistics, let's let wisdom, time-proven strategies, and truth be our guide rather than thinking that whatever is happening right now is going to happen forever, because that doesn't happen. All right, see you in a minute. Hi, everyone. This is Natalie Pace, and welcome back. It is August 6th, 2020. Today's subject, again, is what is safe? So I think that I should show you some data, statistics, information so you understand why this is a very big issue. Okay, let's dig right into it. I'm going to share the screen and show you a few things. So the first thing I want to show you is the latest World Economic Outlook growth projections. So as you can see here, the US is expected to contract 8% in the 2020. Canada, 8.4%, that's negative number. Europe, worse, much worse. UK, worse as well. The only one really on here that might do okay is China. I've seen statistics that Vietnam might do okay as well. So it's really important that you understand that the stock market is not the economy. The economy is contracting, and by comparison, this is way worse than the Great Recession was. So if we're going to have minus 8% this year, that is worse than the Great Recession. And that's really important to keep in mind, especially when you see the stock market going up. Now, the Dow has not fully recovered. The high was over 29,500. So, even though you're hearing all kinds of things about the Dow doing so well, it's still really important to remember just how far and how fast that it did drop, because you are at risk in a global recession. There are many reasons why. Part of that is valuation. Another part of that is liquidity. Another part of that is leverage. But the bottom line is that stocks have been going up almost in an irrational sense. And when we talk about pricing, the only two times that stocks have been this expensive was before the Great Depression in 1929 and before the Great Recession, the dot-com recession, in 2000. And both of those times were devastating to investors. So let's talk a little bit more about the safe side. What's safe in an unprecedented recession that could actually be more like the Great Depression? Hopefully not as long, but we are in for some very, very severe things going on, including a potential credit downgrade. Canada was just downgraded to AA from AAA by Fitch, and the US was downgraded to AA August 5th, 2011 by Standard & Poor's, but we still retained our AAA with Fitch and Moody's. They've both warned us that A, our debt is way too high, and B, we don't have a good plan of how that's going to get reduced. So in other words, we are at risk of losing our AAA status as well. What happens then? We have the last time that we lost it in 2011 to look back to. So what happened then? Gold went to its all-time high and stocks went down. Now, stocks didn't go down as much as they did in the Great Recession. They lost more than 55% in the Great Recession. They lost 78% in the NASDAQ in the dot-com recession. So the numbers are staggering. And yes, this is different than a normal recession. There are reasons for that. A lot of it has to do with demographics. Canada, the US, Europe, we all have an aging population, a lot more retirees that we have to support. And there are other reasons as well, including leverage and obviously the financial crisis that we find ourselves in due to the coronavirus. So it's all of these things. In other words, what really happened is that we didn't fix the roof while the sun was still shining. And then when the coronavirus pandemic hit, we now are deluged with economic storms. And again, for those of you that are joining a little bit later, you're going to need to go back and watch the beginning of this so that you can see how bad these storms are. So we just had the worst quarter that we've had in recorded history. So they just started recording the quarters in 1947. They don't go back quarterly to the Great Depression. But since 1947, this is the worst quarter contraction. That's almost 33%, 32.9%. On the year, it's expected to be minus 8% year over year. And again, that is far worse than it was in the Great Recession. So what can you do to get safe? How can you protect your wealth? How can you protect your home? And what is safe in a world where there's so much leverage? What do I mean by that? Well, there's so much debt in the world that consumer debt is back to an all-time high. The last time I looked at our public debt, which increases every single day, it was 26.5 trillion. As kind of as a monitor of that, when the current administration came into office, it was 20 trillion. So it's now up 6.5 trillion. It was already 23.5 trillion before the pandemic. So it was still increasing at an unsustainable rate. At the same rate that it was before this administration came in, but up to 26.5 trillion in the US. Consumer debt is back to an all-time high. The amount of mortgages that are in forbearance is almost 8%. 3.6 million homes are severely underwater, and that's at a time when real estate prices are at an all-time high. And this is a statistic. I know they're coming hard and fast at you, but and so don't let your mind go numb, but this is an important one. Over half of the S&P 500 companies are either in junk bond status or one rung away, and that was before the pandemic. So those that lost income are at severe threat of a downgrade. And that makes your bond illiquid. What does that mean? That means you may not be able to sell it. You got to pray and hope that it goes all the way to term. So if you have a 30-year Ford bond, sorry about that. Might not be a great idea now that it's in junk bond status. So it's really important that you know what you own, that you know what is safe, you know what the risks are, that you read the fine print, that you get as much control and freedom as you can, that you have liquidity in case of an emergency, that you do a home check, even if you feel equity rich. So all of these things are important. We're going to look at them one by one. I'm going to show you a few more slides as I talk. Okay, here we go. Okay, so again, this is the what I showed you at the beginning of the growth projections. They're actually not growth, they're contractions of the developed world. And the only one that's expected to come in the black this year is China and maybe Vietnam. The rest of us are going to contract, and Canada, the US, pretty bad, maybe not as bad as most of Europe. All right, so what can you do? The first thing is that you always want to keep a percent equal to your age safe, and you need to overweight safe in a recession. We are absolutely in a recession. It began on February 19th, 2020. Even though stocks have gotten a good rally, and NASDAQ is actually at its all-time high again, not the Dow, but the NASDAQ, so more technology and biotech stocks, the younger companies are not. Dow tends to have more debt-laden companies. That's why it's not recovered as well. Now, so keep a percent equal to your age safe, and then you want to be properly diversifying. You need to be rebalancing 1 to 3 times a year so that you are capturing gains. It's a buy low, sell high plan on autopilot when you're rebalancing 1 to 3 times a year. How do you rebalance? Well, you have to mock up what you have into a pie chart, and that means that you've got to put all of the large cap values into one slice, all the large cap growths into one slice, etc. All of your hots, whether it's gold in one slice, whatever it is that you've designated as hot, you stick them in that one slice. And then you want to make what you have look like what you should have. So again, this is a chart assuming you're 50. I have a sample chart assuming you're 25. And if you would like to personalize your own pie chart, we have web apps for that. This takes less than 5 minutes. Your age, your annual income, your liquid assets, submit, and it puts in your personalized pie chart for you. You can also do a personalized Thrive budget as well. So you can see that this is going to take, this is 3 clicks, this is 1 click, and it's done. It's definitely worth doing. Let's go back to that pie chart real quickly so we can see what is safe. So bonds and money market funds are vulnerable. FDIC insured cash is safer. Safe income producing hard assets that you purchase for a good price, considering a post-pandemic world, should be better because hard assets will hold their value better than paper assets. But you have to look at the equity in it. I want to show you one other screen real quickly, so you know where you can get some extra resources here. So this is nataliepace.com/blog. So as we can see, technology and silver are golden. I think you should read this blog. These might make good hots for you. We talk about why silver is up, has doubled since the low in March. Technology is up 58% since the low in March. These are really strong, but you don't go all in because both of those lost more than half between February 19th and March 23rd. So that's why you limit yourself to slices. And when the slice gets thin, it's saying buy more low. And when the slice gets too big, it's saying sell high and trim back, unless you want to have 2 slices. Okay. At the bottom of each blog, there is a list of blogs. Sorry, it didn't go there because there's a list of other blogs. There we go. So if you want to read about the contraction in the economy and what that means, this one I think is really important as part of the safe side, because a lot of people feel like they're equity rich, and you want to make sure that feeling isn't fleeting. A lot of people felt like they were equity rich in the Great Recession before the real estate bubble popped. And right now, real estate is unaffordable in 74% of the US cities. When real estate, whether you're a renter or a homeowner, if you can't afford it, then that puts pressure on prices to go down. So you really want to make sure that you remember how it felt. If you owned your own home during the Great Recession, go back to how it felt when it dropped as low as it did. And if you think that you're okay with that because you have your home paid off and you plan on living there for another 10 years or 20 years, great. If it felt horrible and you're also afraid of losing your income and you think it might be difficult to pay your rent, then you can still sell your home very high. Now, a lot of people say, oh, well, then I'll never be able to afford a home again. Well, that's not what history tells us. History actually tells us that the last recession, you could have bought your home for probably half of what you paid for it today in most cities in the United States. So that is a strategy that you could use. You could sell high, you could rent for a year. You might even think about where you would want to retire or relocate to. A lot of people that are living in very expensive cities, now that we can work from home, they don't need to live there anymore. So you might think of, oh, maybe I want to move closer to family. No one knows what the right answer is for you, but what isn't the right answer is just riding the Wall Street roller coaster up and down, or losing half of your home equity, being underwater and being in trouble. That's what we want to avoid. Okay, so some other things that we want to make sure about. The safest is FDIC insured cash as the first step. There will be inflation. Will it be hyperinflation? Probably not. We had a period of deflation that might still be in there. So that meant that prices went down in everything except for perhaps food. Like even right now, it's cheaper to buy a smartphone. You can trade in your old smartphone and they'll finance it with 0% financing, and it's cheaper than it was even a few months ago. That's true with a lot of things, is that they have just lowered the price to make it so that maybe you'll be seduced into purchase it. That will level out, and once we get working again, the prices will be under pressure to go up again. So will they go into hyperinflation? It's not predicted. So a lot of people, I'm hearing a lot of chatter about that. That is used by people to scare the heck out of you and then sell you whatever product that they're going to call the panacea. Be careful of that. Remember, if you are thinking about a panacea, make it a slice. Don't do the whole Hail Mary investment on that. Okay. The truth is, in a recession or in a depression or in the apocalypse, what will be easier to sell? Maybe some of your own Wi-Fi so people can get online and do their business, or a gold coin. Also, you have to be careful about gold coins because A, gold is already at its all-time high. And B, when you purchase a gold coin, oftentimes they upsell it. So in other words, you're not just buying the exact value of it would be in gold, they're saying that it's collectible, etc. Also, if you read my gold blog, the one on technology, but I also have a gold blog right here, so gold soars, some gold funds tank, then you'll see that there's another asset in commodities that I think is actually a better opportunity than gold right now. Also, we've seen that gold funds have had issues, especially some gold funds. So I explain why that is the case in that blog. So whether you're looking for real estate solutions, if you need to make sure to double check that your home is something you can afford. Also, even if you're equity rich, this is for you. And obviously there are a boatload of other blogs here for you to read and check out if you need to. Just double check and look on things that you're very interested in investing in, whether it's emerging markets or copper, etc. All right, so I want to also mention that, remind you that you have to read the fine print. So if you have a 401k or an IRA and you think you've gotten safe, you have to read the fine print, because a lot of times they'll put you into a money market fund, or a bond fund may have 20% of junk bonds and mortgage-backed securities in it. So you have to know what you own, and you have to read the fine print. There are redemption gates and liquidity fees, and these are not things that you can ignore. Let me show you another chart. So this is a chart of the global mutual fund redemption suspensions that are occurring already in 2020. Now, they're mostly happening in Europe, but your money market funds now have redemption gates and liquidity fees. And the truth is that if the Federal Reserve had not bailed them out on March 15th, then you might already have had a redemption suspension. What does that mean? That means you can't access your money. Or a liquidity fee, that means you get charged for access to your money. Most money market funds are paying about 1%. If you add in the fees, they're paying about 0.5%. And then you're not going to have access to your money. So that's not so good. So a couple of the other things that I want you to do are, and this is a checklist for you. So FDIC insured cash is the first step. Safe income producing hard assets that you purchase for a good price, considering a post-pandemic world, are going to hold their value better and give you a better, safer yield than most of the paper assets, because there's too much paper floating around. But hard assets are at an all-time high. So you're going to have to be a patient, opportunistic buyer. There is shadow inventory, so you can start looking there. As one example, the high for real estate before the Great Recession was in 2007. The low is 2011. So the crash doesn't happen like that because the banks don't want them to happen like that. Otherwise, they would all have to go bankrupt, right? So they want an orderly procession into foreclosures. I also want you to be checking the fine print on all of your products. Redemption gates and liquidity fees apply to money market funds, but they can also apply to mutual funds. So if you have a 401k and an IRA, now is the time to check and see if you have a self-directed option, or if you're 59 and a half, you can roll it over into an IRA so that you have the universe of stocks and bonds and FDIC insured cash available to you instead of the limited amount of options in a 401k. You still will keep your 401k open. You'll still contribute to it going forward, but you can roll over the existing so that you have the majority of your wealth under your own control. And you have to know what you own, and you have to know why. Now, if this sounds like too much work, let me just tell you this. This is the most important job that you have, is protecting your wealth this year. If you have any wealth to protect, your most important job is protecting it. If you need help, get a second opinion. I offer an unbiased second opinion. We don't sell financial products. I can tell you what you have at risk and why, and then you're the boss of your money. You can choose to follow an action plan that protects you better or not, your choice. But at least you can't be the boss of your money if you don't know what you own, and if you don't know what a healthy strategy looks like, and you don't know how to get there. You need to right size your budget. So I want you to consider a post-pandemic world and the possibility that you're earning less income or that your future is less secure. And you want to make sure that you have emergency access to money. Now, you can actually get a loan from your 401k or your IRA, but you will have to have it liquid enough that you don't have to liquidate something potentially for a loss if the markets have gone down. So that means that you do want to have a percent equal to your age safe, and that should be some, at least a portion of that should be easy to access, no redemption gate, no liquidity fees, no reason why you don't have access to your own money. Evaluate your home value, even if you're equity rich, and if you're not equity rich, really evaluate it. If you are nearing retirement, you should try to align your payoff date of your mortgage with your retirement date. Bonds, if you're going to hold them, keep the terms short and the credit risk very, very low. AAA. If you're looking at an A, I heard somebody say, oh, this is a really good one. It's A+++++++. I said, no, A, it goes triple A, double A, triple B, junk. So A is only 2 rungs above junk. Even don't care how many pluses they put behind it. I already said that over half the S&P 500 is at or near junk status. There are mortgage-backed securities and junk bonds in most bond funds, even those that call themselves investment grade. Be sure that you're aware of how much at risk you have in your bond funds. They lost a lot of money between February 21st and March 23rd, and bonds are supposed to be the safe side. So they're not supposed to lose money. You want to take risk in stocks because you get a greater reward there. You don't want to be losing money on the safe side too. And there's always an opportunity cost. That's one of the reasons why we want to keep the terms shorter. If you're locked into a money market, well, money market funds don't have that unless you, of course, run into a redemption gate. But if you come into a bond, and look, a junk bond can still only be paying you like 4%. And what if it goes out for 30 years? I've seen bonds that are going out for 40 or 50 years, and they're paying under 5%. Well, not only are you at risk that in that period of time they'll have to restructure and you're going to take a haircut on your principal. So you're not getting paid very much and you could lose your principal. That's not good. But the other thing is, if you lock it in for 50 years and it gets a downgrade, nobody is going to buy it from you. So you're going to have to pray and hope that it goes all the way to that 50-year term to get your money back. And in the meantime, if you wanted to buy something else because there was a greater opportunity, you don't have the liquidity to do that. I'm going to leave you with one final thought, and that is that the reason that most people don't buy low in recessions is because they can't buy low. Why is that? Because they lose too much money. When you lose too much money because you haven't gotten enough safe, then you don't have any money to buy low. And all you can do during the recovery, during the bull market, is recover losses and pray and hope that you recover losses. When you protect your money and protect your wealth and have liquidity, then when things and prices correct themselves, which they always do, you have money to be able to buy low. I look forward to our next video conference in September. I actually interviewed the chief fixed income strategist of Charles Schwab. Her name is Kathy A. Jones, earlier today. It's already posted on my YouTube channel. So go to youtube.com/Natalie Pace to access it. I asked her a boatload of questions, and she was extremely transparent, and she is very, very informed and very wise. I strongly encourage you to check that out. All right, and I will see you again soon. Thanks for joining me again. Remember, I do have a retreat coming up, and that is October 3rd through the 5th. I'm going to just show you that flyer real quickly, just in case you're interested. There is actually something noteworthy that I wanted to make sure you guys know about. We're offering a great deal for families. So if you are a repeat attendee, you get a discount. If you're a volunteer, you pay a very low fee. But if you want to put a family group together, you're going to be very shocked at how low the prices are. Every member after the first member is $450. So if you look at these prices, again, remember, if this is your second retreat, you get a lower price. It's a little bit lower. So we're in the regular pricing period. $450 per person for each additional person in the family. If you actually get 5 people in a group, then the 5th person is only going to pay $199. So just something to keep in mind and remember, because I do think it's important. And again, you can just go to nataliepace.com, click on the flyer, and it gives you all of these details, what you're going to learn, the pricing, some important testimonials, etc., so that your friends and family can look at it themselves and see if this is of interest to them. I think it's important for us to be family-minded and community-minded, because it's our family wealth. We don't want our parents to do poorly. We don't want our children to do poorly. It's family wealth, and we want to make sure that everybody is protected. Intergenerational housing is on the rise, and it's an easy solution for housing issues. So I do encourage you to read the blogs. A lot of this stuff is highlighted there. In the retreats, if you attended even last year, it's a brand new retreat because things are moving and changing very, very rapidly. Also, I just did an interview, and it was really funny because this particular person actually attended a retreat. And before that, he had interviewed me, but he didn't quite understand exactly what I did. Afterwards, now he gets it. But he had said, you know, Natalie, I attended your retreat in March, and you were already warning us that we were in a recession. Well, the date this recession began was February 19th. And again, it's not rocket science. The analysts like me who spend their time looking at data and statistics and information know this stuff. FYI, again, when it's not even a question of if, when we get our credit downgrade, that is when gold again could soar. Again, I think that other commodity, which I encourage you to look at in the blog, is a better price and actually tracks gold. So check it out. But that bodes well for gold, even though it's already at an all-time high and very strong. So yeah. All right, I'll see you guys later. Join me at the October retreat. Have as good of a time in this summer as you can, given all the constraints that we're under. Stay healthy, stay safe. You know what to do that. You know what's right for you and your family. And I am very grateful for our community. And I think that our community will be in great shape, and we are going to be we're going to be banded together, and we're going to find solutions, and they're going to be very needed, but we're going to be able to do it because the power of partnerships and wisdom is enormous. I'll see you soon.